on first quarter GDP. 2.3% is the number. It is better than expected. 2.3% is a good number for the first quarter. This is the first reading of the first quarter GDP. Let's get with global economics editor from the Wall Street Journal, John Hilsenrath, with his take on this number. First quarter, first read, 2.3%, better than expectations. John, your take.
Better than expected. You know, I was looking at 1.8 or 1.9. I'd like to see the breakdown. I'm waiting for that to come through in my own inbox. How much of that came from consumer spending, from business investment, from inventories and otherwise. But you actually have to be pretty pleased with these numbers. You know, the first quarter tends to be a little bit softer than other quarters in the year. So, you know, it looks like the economy came through what is usually a soft period pretty well.
Yeah, and we were looking at a weak consumer going into this day, and that's one issue that Stephanie Pomboy keeps bringing up, that she feels that the consumer is saving the money that they got from the tax plan. They're not spending it, and we need to see more consumer spending. Not sure what this number tells us in that regard.
I think it'll be interesting to look at the business component. We're still waiting for the right-through on these numbers. Maybe Kevin has
Yeah, I've got some of it.
But it's very interesting that this came in. This is quite above expectations, but to give Phil Orlando credit, he thought it was going to come in at 2.5%.
Yeah, he did.
So he had the high end of that, and it came in well north of 2%. But it's an economy that is beginning to see the impact of that tax reform.
Yeah, and here's the numbers as they come in. So 1.1 on the consumer spending, which matched the estimates. Non-residential fixed investment was still very solid at 6.1%. So that is the business spending that we're looking at. And then you had inventories and net exports both added to the growth for a combined of 0.63%. So that beat expectations. And when you look at that, when it says net exports and inventories, I mean, that goes back to what we've talked about on, you know, I know tariffs is sort of an ugly word, but the steel and aluminum tariffs, and still having this strong number, adding 0.63 percentage points, that's a really strong, healthy number. And getting back to John's point, 5 of the past 8 years, the first quarter turned out to be the worst one of the year. If the worst one is 2.3% this year, we're going to get above 3% GDP.
You're right. Hey, look at business look at business spending, Dagan. 6.1% on business spending. Yeah. That is a big number. John, that's one of the big issues here for this economy. Business is spending money. They were sitting on capital for the 8 years under the Obama administration, and animal spirits have been moved.
Yeah, I'd say a couple of things on the business investment. The 6% number is pretty good. It's actually a slowdown from the fourth quarter. You know, I'm still trying to figure out how the tax cuts affected investment. It might have been the case that businesses pulled investment back into the fourth quarter of last year because some of those tax cuts were retroactive, and so that might account for the slowdown. The other thing I would say is the inventory piece of this isn't something to get excited about. When inventories add to growth, you know, we have inventories piling up in people's shelves. You tend to get some payback later on.
Wait, but aren't they adding inventories because the anticipation of selling and future business sales from that, right? So you're only going to add inventory if you expect economic activity to grow further.
It could go that way, or it could be the case that they added inventory they didn't expect to add because they produced stuff that didn't get sold. So, you know, all I'm saying is that sometimes when you get an inventory buildup, there's some payback later on.
To back up, you raised this issue, what Stephanie Pomboy has been talking about. What are consumers doing with their money? Personal saving came in much higher in the first quarter than it did in the fourth. The personal saving rate as a percentage of disposable personal income was 3.1%. That's compared with 2.6% in the fourth quarter. So it went. Personal saving was at $462.1 billion in the first quarter.
How about the PCE? Did you see the PCE? The PCE, John, 2.7%.
2.5%.
Well, 2.
I have 2.5.
All right, we got the core at 2.5, but regardless, this number is the number that the Federal Reserve focuses on, right, in terms of inflation.
It certainly is, and we've been expecting a pickup, and we're getting it now. You know, so that keeps the Fed on track to do at least 3 interest rate increases this year, and possibly a 4th out in December. So, you know, those inflation numbers, we're expecting them to firm, and that's exactly what we're seeing. You know, inflation has been running below the Fed's 2% target for, years now. So I wouldn't see them getting alarmed by these numbers. But it shows them that their forecast is on track, and they're going to keep raising interest rates.
Well, you said the Fed's not going to do anything next week. We had a Fed meeting next week. Kevin, your thoughts on this PCE number at 2.5% on the core?
Yeah, this is
going into the Fed meeting next
Listen,
week.
this is the fastest since 2011 on an annualized pace, and core PCE has actually overshot on the services side. We're 70% services economy, and so I want to get the breakdown of this number, what that is. Because if that goes back into where the consumer is spending even more, I mean, we could actually see a higher tick up in inflation that could exceed the Fed's expectations, that could lead to 4 rate hikes. Would that 4th rate hike be in December?
Yeah, Maria, as to next week, they tend to do their rate increases in meetings where they have press conferences and put out new forecasts. They don't have a press conference. They're not putting out a new forecast next week. So they'll wait until June. But, I think it would have to have been really strong numbers to get them to move in a non-press conference meeting.
I thought you once said, I said that on this show in 2016, that they only do rate increases when they have a press conference. And granted, Janet Yellen was running the central bank then. You told me that wasn't true, that they could raise interest rates, because we were debating how many times they would hike ahead of the presidential election. I think you shot me down, John Hilsenrath.
Well, in theory, they could do it anytime they want, but they're only going to do it
when they can
in a
explain
non-press conference meeting if, something unusual happens, and nothing unusual happens, so they're not going to do it now.
John, I just want to put this number in context once again. We were talking about a 1.8 number coming into this conversation. We're now talking about 2.3. The conversation throughout the year has been we're going to get 3% growth this year on the back of 1.8 in the first quarter. Now we've got 2.3 in the first quarter. Where does that take your full year projection for what we see in GDP?
Well, I mean, I don't know. I mean, I've got to look a little more carefully at these breakdowns, but I think most people are going to keep their. I don't do a forecast for GDP, but I think most of the economists on Wall Street are going to keep their numbers around where they are. Maybe you shade it a little bit to the upside, but again, as I said, the inventory piece is one reason why you might expect some payback later on.
Stephanie Pomboy agrees with you on that. Ex-inventories GDP was 1.9%, in line with expectations. Slower consumer, deflationary combo, says Stephanie Pomboy.
Yep, U.S. private sector wages lodged biggest gains since 2008.
There you go.